The year 2025 began with unease in global markets. Dark clouds gathered, signaling an impending storm. By April, the storm hit, sending shockwaves through the financial world. The catalyst? Sweeping import tariffs by the United States. These tariffs targeted major economies like Canada, Mexico, and China. Global trade ground to a standstill. Fear gripped investors as stock markets plummeted. The US dollar faltered, reflecting the turmoil. The repercussions were swift and brutal. Geopolitical tensions soared, casting a shadow over global stability. Economic growth slowed, with the U.S. economy teetering on stagnation. Inflation fueled fears of prolonged stagflation. The crash reminded us of the interconnectedness of the global economy. Investors grappled with uncertainty, searching for answers. The April 2025 crash, though unique in its triggers, bears eerie similarities to market crashes of the past. The Great Depression of 1929, the dot-com bubble burst in 2000, and the 2008 financial crisis, each market meltdown, though separated by decades, shares a common thread, a period of irrational exuberance followed by a rude awakening. The 1929 crash, triggered by excessive speculation in the stock market, led to a decade-long depression, forever etching itself into financial history. The dot-com bubble, fueled by unbridled enthusiasm for internet companies, evaporated as quickly as it had inflated, leaving behind a trail of bankruptcies and shattered dreams. The 2008 crisis, rooted in subprime mortgages and lax lending practices, exposed the fragility of the global financial system. Each of these crashes taught investors valuable lessons. First, markets move in cycles. Periods of euphoria are inevitably followed by periods of fear and despair. Second, diversification is key to mitigating risk. A well-diversified portfolio can cushion the blow during market downturns. Finally, and perhaps most importantly, market crashes, while undoubtedly painful, often present buying opportunities for those with a long-term perspective. The April 2025 crash, while unsettling, is not an anomaly. Market corrections are a natural part of the economic cycle. The key to navigating such turbulent times lies in adopting a long-term perspective and employing defensive strategies. Panic selling, often driven by fear and emotion, can be detrimental to long-term wealth creation. Instead of succumbing to panic, investors should view market downturns as opportunities to acquire quality assets at discounted prices. This strategy, often referred to as buying the dip, requires discipline and a contrarian mindset. As Warren Buffett famously quipped, "Be fearful when others are greedy, and greedy when others are fearful." Dollar cost averaging is another powerful tool for navigating volatile markets. This strategy involves investing a fixed amount of money at regular intervals, regardless of market fluctuations. By buying more shares when prices are low and fewer shares when prices are high, investors can lower their average cost per share over time. Remember, market crashes are not the time to abandon sound investment principles. Instead, they present an opportunity to reevaluate your portfolio, refine your strategy, and emerge from the downturn stronger than before. Diversification, often touted as the only free lunch in investing, is paramount during times of market turmoil. A well-diversified portfolio spread across different asset classes can act as a shock absorber, mitigating losses and smoothing out returns over time. The key lies in understanding the interplay between different asset classes and their respective risk-return profiles. Equities, representing ownership in companies, offer the potential for high returns, but come with inherent volatility. Bonds, on the other hand, represent debt securities and typically provide income and stability, albeit with lower return potential. Real estate, a tangible asset class, offers diversification benefits and a hedge against inflation. Precious metals, such as gold and silver, have historically served as safe havens during periods of economic uncertainty. Each asset class marches to the beat of its own drum, influenced by different economic factors. By diversifying across these asset classes, investors can create a portfolio that can weather a variety of market storms. Section 5. seeking refuge, defensive sectors, and safe havens. Within the equity market, certain sectors tend to hold up better during economic downturns. These defensive sectors, often characterized by stable earnings and consistent dividends, provide a degree of insulation from market volatility. Consumer staples, healthcare, and utilities are prime examples of defensive sectors. Consumer staples companies providing essential goods and services are less affected by economic cycles as demand for their products remains relatively stable. Healthcare, an ever-growing sector, benefits from the non-cyclical nature of healthcare spending. Utilities providing essential services such as electricity and water enjoy a high degree of demand inelasticity. In addition to defensive sectors, investors often flock to safe haven assets during times of market stress. U.S. Treasuries, considered among the safest investments globally, tend to appreciate in value as investors seek safety and liquidity. Gold, the ultimate safe haven asset, has a long history of preserving wealth during periods of economic and geopolitical uncertainty. Section 6. Advanced Maneuvers. Navigating volatility with sophisticated tools. For investors seeking to further enhance their portfolio's resilience during market downturns, several advanced strategies merit consideration. Low volatility ETFs, as the name suggests, offer exposure to a basket of stocks that have historically exhibited lower price fluctuations compared to the broader market. These ETFs aim to provide smoother returns, albeit with potentially lower upside potential. Risk parity, another sophisticated strategy, seeks to allocate risk equally across different asset classes, rather than based on capital allocation. This approach involves determining the volatility of each asset class and then weighting them accordingly to achieve a balanced risk profile. The permanent portfolio, a strategy popularized by Harry Brown, advocates for a static allocation of 25% each to stocks, bonds, cash or T-bills and gold. This simple yet effective strategy aims to provide consistent returns regardless of market conditions. While these advanced strategies may not be suitable for all investors, they offer valuable tools for navigating volatility and preserving capital during turbulent times. Section 7. Charting your course. Actionable steps for investors. Navigating a market crash requires a cool head and a well-defined plan. Assess your financial situation and ensure you have an emergency fund. Revisit your budget and risk tolerance. Develop an asset allocation plan and automate investments. Monitor economic indicators for valuable insights. Section 8. A glimmer on the horizon. Market recovery and future outlook. While market crashes are undoubtedly painful, they are not indicative of the end of investing. History has shown that markets are cyclical, and periods of decline are invariably followed by periods of recovery. The timing and trajectory of market recoveries are notoriously difficult to predict, but several factors can signal a potential turnaround. A sustained rebound in stock indices, accompanied by positive economic data such as GDP growth, job creation, and corporate earnings, can indicate that the worst is over and a recovery is underway. Investor sentiment, often a contrarian indicator, can also provide clues. When investor sentiment reaches extreme pessimism, it can signal a potential market bottom, as most of the bad news is already priced in. The post-crash landscape may present opportunities for growth in new and innovative sectors. Technological advancements, particularly in areas such as artificial intelligence, cloud computing, and renewable energy, are likely to drive future economic growth. Investors who identify and invest in these emerging trends may be well positioned to benefit from the eventual market recovery. Section 9. Staying the course. Discipline and patience in the face of uncertainty. Navigating a market crash is as much a test of temperament as it is a test of investment acumen. The ability to remain disciplined and patient during times of extreme volatility is crucial to long-term investment success. It's easy to get caught up in the fear and panic that often accompany market downturns, leading to rash decisions that can have lasting consequences. Remember, market crashes are a natural part of the economic cycle. They present opportunities to reevaluate your portfolio, refine your strategy, and acquire quality assets at discounted prices. By adhering to sound investment principles, maintaining a long-term perspective, and staying the course, investors can navigate the storm and emerge stronger on the other side. As Warren Buffett wisely observed, the stock market is a device for transferring money from the impatient to the patient.